Ask any dividend investor and they will tell you the exact same thing. The best part of owning dividend stocks is seeing that beautiful dividend hitting your trading account. So, what if I told you there are stocks that pay you dividends every single month? I know, right? The problem here is that most monthly dividend stocks are horrible, let's be honest. However, there are a few which are definitely worth researching. Today, I have 3 solid dividend stocks to show you. All of them pay dividends every single month, all of them have a dividend yield of above 4%, and all of them operate in the real estate industry. Before we look at the first company, however, I want to give you a quick breakdown of what you look for in real estate investment trusts. A lot of people look at their price to earnings ratio and things like that, but real estate investment trusts are actually different from your average company. With them, you need to look at the funds from operations, not earnings. This metric gives us a much better idea of the underlying business performance. To find the funds from operation, you basically need to add depreciation, amortization, and losses on sales of assets to the earnings, and then subtract any gains on sales of assets and any interest income. The thing that we're looking for here is growth. Consistent increase in funds from operations means one thing, and that's that the real estate investment trust is doing well. Another important metric to look at is the tangible book value per share. Real estate investment trusts are essentially a big portfolio of different properties, and the tangible book value gives us an idea of whether the value of these underlying properties is growing or not. This is extremely important because the funds that a real estate investment trust generates are linked to the value of those underlying properties. Other important metrics include the credit rating because that decides how cheap it will be for the real estate investment trust to borrow money. Then you have to look at the leverage ratio, the payout. Obviously, the dividend is also important, so we will be looking for both a strong dividend yield and a history of dividend raises. So strap in, boys and girls, and let's take a look at the first companies. The first company on the list, and probably the most popular one, is Realty Income, trading under the symbol O. Just O, plain and simple, just like their business model. Realty Income is known as the monthly dividend company and is a real estate investment trust that is part of the S&P 500. As of the 8th of February, Realty Income is also the 7th biggest REIT in the US with a market cap of $42.4 billion. They have over 11,700 commercial properties, occupied by over 1,100 different clients in 79 separate industries. This is really one of the best parts of Realty Income. They are one of the most diversified REITs out there. That provides them with stability, results in low risk, and also gives them the ability to consistently and gradually raise their dividend. So far, Realty Income has had 101 consecutive quarters of dividend increases, and that's a lot. Over the last 10 years, Realty Income's dividend has increased by an annualized average of 5.4%, which is way higher than the sector median of 3.15%. Currently, their dividend yield stands at 4.43% at a price of $67.37. Looking at the metrics that I mentioned previously, we have decent funds from operations with an adjusted FFO per share of $3.86, with an average 5-year historical growth of 4.5% compared to the sector median's 1.6%, so that's looking good. Their tangible book value per share is $28.6, and again, the historical growth is looking very good with a 9.5% annualized growth over the last 10 years. Unfortunately, the price to tangible book value ratio looks a bit pricey at 2.36, although, like we saw, the company was showing some good growth there. Realty Income's debt to equity ratio is looking good too, standing at 62.9% versus the industry median of 94.8%. Realty Income's credit is currently rated as an A3 by Moody's and A- by S&P with a stable outlook, which is very good to see too, and means that the company will have no credit issues in the foreseeable future. Overall, the Realty Income stock is an extremely solid choice. Plus, it is still trading at about 15% below its pre-pandemic peak. There are 2 things here that I want to mention. One is that Realty Income is trading at a slight premium to the rest of the industry when it comes to price to forward funds from operations. However, it is understandable given that the company is solid. The second thing is that we are obviously seeing the highest interest rates in 15 years or so. Realty Income claim that they are actually outperforming the markets during an interest rate hike, and to be fair, they are correct. However, that was then and this is now. We don't know how the stock will perform this time around, so bear that in mind. The second company is LTC Properties, trading under the symbol LTC. LTC invests in senior housing and healthcare properties and holds 216 properties in 29 states, with 32 operating partners. LTC's portfolio is comprised of approximately 50% senior housing and 50% skilled nursing properties. The company is a lot smaller, with a market capitalization of just 1.5 billion. However, the dividend yield is much bigger. Currently, LTC's dividend yield stands at 6.18% on a price of $36.84. The downside here is that they haven't raised dividends since September of 2016. On the bright side, their tangible book value has gone up over the last couple of years, although it is still just $19.83 per share, below the 2018 peak of $20.82. Still, the LTC stock only has a price to tangible book value ratio of just 1.85, which is actually good value. Their FFO has been a bit rocky over the last few years too. LTC's peak FFO was in December of 2017. Since then, the FFO has dropped from $3.1 to $2.4, which is not great. However, it is looking like management is trying to turn things around. I haven't been able to find LTC's credit rating anywhere, but their latest financials show that their total debt has a weighted average interest of 4%, which is really good. Their debt to equity is about 96%, which is just above the industry median of 94.8%. Overall, with LTC, you are getting a discount and a higher dividend because the business has gone through a rough patch. They're currently trading at about 30% below their pre-pandemic high, so you will be getting a good deal. On the flip side, you are buying into a risky business, so again, bear that in mind. The third and final company is STAG Industrial, trading under the symbol STAG. With a market capitalization of 6.5 billion, STAG Industrial is a REIT focused on the acquisition and operation of single-tenant industrial properties throughout the United States. As of the latest data, STAG owned 563 properties in 41 states, spanning a total of 111.6 million square feet. In fact, STAG is one of the biggest owners and operators of US industrial real estate, so if that's a sector that you're interested in, STAG is definitely worth investigating. Their dividend yield currently stands at 4.04% on a price of $36.37. They have been raising dividends every single year for 11 years, but in all fairness, it looks like recently they've just been doing it so they can say that they've done it. The compounded annual growth rate for their dividends since 2015 is just under 1%, so it is pretty negligible. Now, what about their operations and assets? Well, their funds from operations have been growing steadily every single year since 2014. The compounded FFO growth is 6.5% since 2014, and they are expected to keep growing by about 4.7% going forward. Their tangible book value has also been going straight up. Over the last 10 years, it has gone from $5.14 to $16.12, which gives us an annual compounded growth rate of 12.1%. Personally, I love seeing these double digits. I'm not gonna lie, the STAG stock is starting to look like a very attractive pick to me. STAG's credit rating is currently a BBB. I personally like seeing A's, but I'll make an exception for STAG because they do have low interest rates on their debt of around 3.5%, almost all of it being in unsecured notes. Plus, they have a steady free cash flow of $75 million and are getting a grip on their payout ratio, lowering it from 99% in 2015 to 78% in their latest report at the end of 2022. Overall, STAG is looking like a solid pick. However, just like with Realty Income, STAG does have a premium attached to it and trades a bit above the industry median when it comes to both price to funds from operations and price to tangible book value. Still, it is trading about 25% below its peak of $47.9. So, these were my top 3 monthly dividend stocks for February 2023. Realty Income and STAG are solid picks, but you do get a better deal with LTC properties, although you would be taking on a bigger risk. Now, this is not meant to be financial advice or the be-all end-all research. Make sure you do your own reading, poke the stats, kick the tires and so on before making up your mind. If you enjoyed the video, please drop a like, leave a comment, share it with a friend. Thanks for watching and I will talk to you again soon.